Mark, can you shift the screen to me, please?
I can. I'll let you take it away. You should
What
have
I'm
it now.
showing on the screen is the manifest home screen, and over on the right-hand side here, you'll see published dashboards. I'm hitting more, and I'm getting a list of published dashboards that are all public on the manifest site, and I've scrolled down to the bottom and I've hit Roundtable. In other words, the Roundtable dashboard is available to the subscribers, and it's also available to anybody else with this slug at the top, with the URL at the top up there. So anybody can access this dashboard, and if you're a subscriber to Manifest, you can actually play with it a little bit. So since I am a subscriber, I'm playing with it, and I've ordered it by par. And what I'm going to do is try to make the point that when a portfolio reaches a certain size and you're adding funds on a regular basis, Manifest provides a method of letting money trickle into the portfolio, helping you to manage your portfolio and not always having to study every single stock in the portfolio, trying to keep an eye on what's going on. The classic method is to go to the top of the sweet spot in your own portfolio. So for my portfolio, for the Roundtable portfolio, that would be right here between Adobe and Massimo. Notice Massimo is just outside of the sweet spot at 18.1% par, and Adobe is just at the top of the sweet spot at 17.1% par. Well, it's to take a look at the stock at the top of the sweet spot, so that's Adobe. Next, I take a look at its relative size in the portfolio. It only represents 1.6%, so I so far haven't disqualified it. What I do real quickly after that is go to a value line, and I'm looking at Adobe. I love the low return number here. The present price is extremely near the current price, so that return is pretty accurate from Value Line's point of view. So I'm going to read the Value Line, of course. This 4 up here doesn't bother me at all. Remember, my time frame is 5 years, not just a single year going out in the future. So once I get this number here, this low return, and once I'm certain that it's a fairly accurate number from Value Line's point of view, then I'm going to move to the manifest, then I'm going to move to my SSG, and here's the SSG for Adobe. It should look pretty good, unless, of course, it's Bank of America, but this Adobe SSG looks fairly decent. It's a little bit raggedy. The company probably is a little bit more challenging to study than some of the companies we look like that are railroad tracks. But since it's already in our portfolio, it's already been vetted by the group, and we haven't decided to turn around and throw it out. So I'm considering it for purchasing more of the particular stock. It did have a rough last quarter. I'm turning it over. I'm looking at the metrics here. I notice that margins are pointing down compared to the 5-year average, but they have been moving up since the recession in 2009. Return on equity is moving in the right direction. I do a quick SSG. I get a return very close to Manifest's return. I like that a lot. And then what I do is I go to the website and I start reading. I just think Adobe is positioned to do everything that is currently being talked about in the market. I go to Adobe and I find out that they're moving very quickly from subscription items to cloud subscriptions, which means that you pay a certain amount each month for a product rather than a single large amount to use a product once. Adobe is positioning itself not only in the area of creating materials, creating electronic materials, like PDFs, for example, but it's also positioning itself in the retail space and creating all types of applications for retailers to use online. I happen to think that's a growing trend and it's not going to go away. So I don't find anything that I don't especially like about Adobe. I'm not committing huge amounts of money on a monthly basis, and therefore I feel quite comfortable. And I'm going back to my manifest dashboard here. I feel quite comfortable in putting another $1,000 into Adobe systems, so that's what I'll do.
Sounds good. Thanks, Ken. It also sounds a little bit suspiciously like jumping on coattails, Houston coattails.
You know, I don't have any problems doing that if it's a good idea. I don't ever not buy a stock because of who recommends it, and I don't ever rush out to buy something because of who recommends it either. So I think that if it's a good idea, it's a good idea, and the fact that it came from one of our damsels shouldn't stop me from jumping in and participating in the riches.
Not at all. All right, well, with that, we've got a couple slides to go. Let's close down with a couple of things here. The People's Choice Award from 2010 had to do with Ken's dissertation on the connection between Cleveland, Ohio, and Poland and China with respect to Zhangpin, ticker symbol HOGS. And it was one of the more entertaining stories that we had last year, even if it's been a little bit of a tough road for the company. And this year we have 3 nominees, and it's been quite the horse race, but 3 nominees. Kim Butcher's Deere presentation, which again is literally 4 months old. The stock is up 40%. So that's just a natural one to point out there, where Kim actually pointed out that we probably should spend a little time in the industrial sector also. The second nomination there was Hugh and his presentation of more Spock, less Kirk when it comes to investing from approximately a year ago. And we've actually kicked that one around a whole lot about the logic of investing, and again, the long-term patient emphasis there also. And last but not least was Cy Lynch's, again, his dissertation approximately a year ago on underscoring the importance of investing in smaller, faster-growing companies and making a blend with the larger, slower-growing companies. So again, that's a topic that we cover greatly or quite often. The race itself, we had voting on Facebook, in the forum, and a couple other different places, private emails. It began to resemble a South Carolina primary a little bit. It was close. It was close, but the nod goes to Mr. McManus again with his more Spock and less Kirk presentation of avoiding the wrong end of the spear.
Well, so thanks. I'm flattered. I still believe that if you go 200 years in the future, you're going to have Vulcans retiring to Earth, enjoying buying in our stock market.
Absolutely, and there's a lot to be taken advantage of there. Yes. And I would encourage anybody, if you did not see any of those presentations, go back and revisit them and see what they might kindle for everyone here. So let's close things down with the best performance in leading roles. We've got the 2010 winners for highest accuracy and highest relative return. They were both Hugh last year. This year, and I have to tell a short story. I'll try to keep it really brief because Hugh had a magical Friday this past week. And it reminded me of a few years ago when my Fighting Illini basketball team went into Ohio State, Columbus, Ohio, and they're 29-0. And they led the basketball game for the entire game except the final 2 seconds. And some guy sunk a three-pointer, and Illinois' undefeated season went down the tubes. Well, as far as I can remember, I don't think Hugh led that many days along the way, but he led on the right day of the year. And he actually got in there. Good timing.
Only day.
He got in there on the highest accuracy for 2011, and then he also snuck in, and Ken led this for the last 3 months. He snuck in and took the highest relative return for 2011 also. So he clearly needs a bigger trophy case out there in Pasadena. And since
he still picks Bank of America.
I know it's kind of annoying, but and the all-time stuff, I had that one all by myself there, and he snuck in there on Friday and joined me in that award. So wow. But probably most importantly, we're all trying to do better, and the all-time leader at this point in time is Ken Kabula, slightly sub-zero, but rapidly improving. All of us are improving across the board. and we look forward to better days ahead. So those are your trophy winners.
Well, and think where I'd be, Mark, if I could just stay away from pork. You know that?
You would be dangerous. Well, just think if I could leave out Rim and Logitech. You know, I have a bunch of home runs to go with those strikeouts. Oh, man. And then we do want to give a special mention to the Danzels, because if they were around long enough, we began including them towards the end of last year. They're a perfect 4 for 4. They're 100% accuracy in their 2011 selections for last year. And
wow.
They also have a staggering relative return. The 4 selections that Ann and Kim made have a positive 9.8. So we're grateful for the boost of the overall portfolio, and we hope to see continuing contribution from the ladies. And just want to say, you know, this is kind of like again, another sports analogy, but not enough at bats to qualify for the batting title, but they have the best batting average here on the team. So just wanted to make that special mention and say thank you.
Impressive, yeah.
Keep it up. We need all the help we can get. So with that, I think
hopefully we will keep on doing well.
Keep after it.
Yeah.
Well, that's the end of our official program, right at the 70-minute time frame. We can't stick around for a few minutes if people have any questions. So, Ken, can we see if anybody's got anything on their mind or questions that they would like to follow up on?
Okay, Mark, I'm gonna try to clear the question poll out here. So, Mary Wrench from Northeast Ohio would like to know, what's the deal between PRAA and the IRS? Mary, you might want to expand on that a little bit. Ann, can you tell us anything that you know about the deal between PRAA and the IRS?
No, I try to find out anything negative about it. The only thing that I saw was there was a deal. I'm going blank on what. I believe it was Missouri or Arkansas, where there was a attorney general had a lawsuit and the court threw it out. That was the only thing that I found. So I don't know anything about the IRS.
Okay. Our next comment comes from Dan Horonek, and Dan wonders if, Ann, if you could attach your stock selection guide to a forum message board after the meeting. He'd like to take a look at it. So maybe if you could put your ITK file up in the Manifest forum so Dan can take a look at it, he'd appreciate that. Okay?
Okay.
All right. And then, Mark, I'm wondering if you planted this next question, but it comes from Susan Galt in Northwest Indiana, and Susan says, what is this Eagle thing?
Well, we love Susan and the Northwestern Indiana bunch for sure. The Eagle thing is the Equity Analysis Guide. It's just an acronym, Equity Analysis Guide, long-term expectations. So all it refers to is kind of an audit of the major assumptions during any stock study. Some people have referred to the stock study process that we, including stock selection guides that we go through, of really filling in 3 major blanks. And the 3 major blanks are the growth expectation for the company, basically the sales growth forecast, and the profitability expectation. That's going to usually be net margin or taxed margins, whatever, however you want to think about it, but the profitability of the company. And last but not least, the valuation multiple or the PE ratio. And the Eagle is just simply a worksheet that places those 3 primary judgments into pretty stark relief and allows you to play what-if games. And the Eagle can actually be found on the Manifest site. Let me go ahead and show where you can get to them. I'll have to click out of this presentation. And let's see here. If you go to the Manifest Investing website and you click on My Studies will give you the opportunity to go in and, for any company that you would like, go in and audit those 3 major assumptions. This happens to be McDonald's that you're seeing here. And again, if you wanted to assume McDonald's might grow at, let's say, just for purposes of discussion, 7%. When you make that change, you actually get a change in all the affected fields that you saw go highlighted there, and it changes the projected annual return. accordingly. So you can play, again, an audit function or a what-if type situation with it. So thanks for the question, Susan.
Our next question is from William Morton, and Bill's asking a question. I think this one goes to Cy. Cy, are you concerned that there's such a high percentage of institutional ownership in the Cognizant stock? Are you concerned by that at all?
The quick answer is no. I don't generally watch that particularly closely, certainly not as a criterion to buy or sell. A high institutional ownership, as is somewhat implied in the question about if they roll out, could there be a severe drop in price? That is certainly a red flag, if you will, or a warning that if you've got high institutional ownership, be aware that it certainly is susceptible to price drop should the company that it's an overreaction as a buying opportunity. Similarly, if you happen to catch a particularly small, little-known company that doesn't have a lot of institutional ownership, then that may be a real sweet find, because then when the institutions discover it as well, it'll drive up the price. So I look at it. I'm aware of the potential impact, but I don't use it as a discriminator to buy or not buy. Certainly not to sell.
Thank you, Cy.
One thing I might add to that, gentlemen, is, again, keep in mind that the average company out there, whatever average is, has an institutional stake of somewhere in the 70 to 75% range. So that should give some context. And the other thing that we encourage people to do when they find a situation like that is perhaps dig in a little bit deeper and find out who the rhinos are. Ann brought up, or Kim brought up, an excellent example of Tweedy Brown. That's a very stable company with a very low turnover rate. So if the company is held by a bunch of Tweedy Browns, that's a whole lot different than if they're held by some of the other space rocket guys out there.
Thanks, Mark. Here's an example of an old dog learning a new trick. This is Noelle Rodman, and Noelle is saying that she noticed when the Wipro quality rating came up that it was a very high quality, but it had an extremely low financial strength attached to it. And she was wondering how that could happen. How could you have a high-quality stock with such a low financial strength?
What's the ticker again?
Wipro is the company, Mark.
Okay, let's take a look and actually see what's at work here. I'm not directly familiar with the company. Okay, it's a consulting company, probably relatively small if I had to guess. Oh yeah, and they basically have a financial strength rating which is suggestive that they don't have a lot of track record. We can go and take a look at that in a second. But that's probably indicative of not having much of a track record. Now, the way that a small company can be at quite an advantage is with a high profitability coming out of the gate and a high growth rate. Those can actually overpower a lack of financial strength for a smaller company or a relatively new company. That's how it can happen, and that's what you're seeing here with the zero in financial strength. It's being overcome by the strength in relative growth and relative profitability. So let's take a quick look at the value line page for it and see what we see. I think this company's got a relatively short track record. They do, just a few years.
Mark, this is Sela you're looking at.
So it's not covered by value line, apparently. Oh, it's not even covered by value line. Okay. Whenever you enter a company that's not covered by value line, you get Sealy, which is ZZ, ticker symbol ZZ. Okay, so it doesn't even have that. So again, it's probably got a fairly limited financial strength rating based on the few people who cover it.
Mark, with that question, we've cleared the question box. I don't see any hands in the air. And it's closing in on 10 o'clock, so it looks like we might be over for another evening.
That's like the trifecta. I want to thank all of you and everybody who participated. Thank you very much. We will be getting the Groundhog celebration underway here shortly. I know Herb's in the audience. Herb's investment club up there looks like they may be headed to the title. And what I find fascinating about this year's Groundhog contest is we're going to see for the first time in 5 years a large number of investment clubs, groups of investors at the very top of the leaderboard. So, Herb, I will be in touch shortly. I mean, you're certainly on the finalist slot, so we'll be in touch to talk about that here in the next few days. And we will be starting up the contest for the next coming year. So start warming up your stock picking engines, and we'll be going forward again with Groundhog 6 here in a few days. So with that, I'd just like to say thanks to all the knights and damsels here tonight. Thank you very much, and we look forward to next month. Everybody have a great time out there, and we'll see you soon. Thank you.
Night, everyone.
Thanks, folks. I'd like to remind everybody that Mid-Michigan is sponsoring Burke on the Road in March. If you'd like more information, Natalie just put things on the website today. Go to the Mid-Michigan website. There's a order form, and perhaps you'll have a chance to join us at Burke on the Road up in Saginaw this coming March. Thank you all. Good night.